Today, we're cackling a big one, India's tax residency rules. Now, I know, it sounds complicated, but think of it like a puzzle. It's super important for millions of people, and by the end of this, all the pieces are going to fit together perfectly.
Okay, so here's the big question, right? In a world where we can be anywhere, where do you actually pay your taxes? For anyone with ties to India, the answer has nothing to do with your passport. It's all about your residential status. Let's dive into what that really means. Here's our game plan. We'll start with the why this matters so much. Then we'll get into the two main tests and, of course, the exceptions. We'll even look at how this works for companies, not just people. And we'll wrap up with a special status called Not Ordinarily Resident. So why do we even care about this? Well, it's simple. Your residential status is the absolute foundation of what you owe. It answers the million-dollar question, are you only taxed on the money you make in India, or does the government look at your income from all over the world? And believe me, this isn't just about taking a box on a form. The financial impact can be huge. Getting this right is the most critical first step to managing your tax life in India.
So how does India figure this out for an individual? Well, it all boils down to two main tests. You just have to pass one of them, just one, and you're considered a resident for that tax year. Let's take a look. Okay, on one hand, you have the stay test. It's super simple. Were you in India for 182 days? Yes or no? On the other hand, you have the look back test. This one's a little more involved. It looks at whether you are in India for at least 60 days this year and a total of 365 days over the last 4 years. Remember, you only need one to pass. Yeah, this one's a piece of cake. 182 days. That's the magic number, about 6 months. If you cross that line in a tax year, that's it. You're a resident. No ifs, ands, or buts. But then you've got the 60-day rule, and this one's a bit more of a puzzle. It's for people who have a pretty significant connection to India, but maybe aren't there all the time. This is where keeping a good travelogue becomes, really, really important. But wait, there's more. Like any good rule book, this one has some really important exceptions. For certain people, that trickier 60-day test, you can just ignore it. So let's see who gets a pass. So, if you're an Indian citizen leaving the country for a new job, say Priya moving to Dubai, this rule doesn't apply to you. Same for Ravi, who's a crew member on an Indian ship. It also doesn't apply to Indian citizens or PIOs who are just visiting, though there's a little catch there we'll get to. For these folks, it's all about that simple 182-day rule. Right, let's zoom in on that special rule for visitors. The Indian citizens or persons of Indian origin who come back to visit. For them, things can get a little more specific, and it all hinges on one particular number. 15 lakh rupees. Remember that number? It's the magic threshold. If a visitor's income from Indian sources goes over this amount in a year, the rules of the game change. It's basically to make sure people with strong economic ties to India are treated fairly from a tax perspective. And what's really interesting is how it changes. You can see it right here. If your income from India is more than 15 lakh rupees, that 60-day test gets stretched out to 120 days. It gives these higher income visitors a little more breathing room, which is pretty handy. Okay, let's move on to something really unique in Indian tax law, the Deemed Resident rule. Think of it as a safety net. It was designed to catch certain high-income Indian citizens who, for whatever reason, aren't tax residents anywhere else in the world. So, how do you find yourself in this situation? Well, it's a 3-part checklist. First, are you an Indian citizen? Check. Second, is your Indian-sourced income over that magic 15 lakh rupee number? Check. And third, are you not paying taxes as a resident in any other country? If you hit all 3, bingo, you're a deemed resident of India. All right, so far we've been talking all about people. But these residency rules aren't just for individuals. Nope, they also apply to other groups, like Hindu undivided families, partnerships, and of course, big companies. The rules are a little different, but they're just as critical. Now, for firms and associations, the most important word on this slide is wholly. That's the key. If even a tiny slice of the control and management is happening from inside India, then the whole thing is considered a resident. The bar to be a non-resident is incredibly high. For companies, it's pretty clear-cut. There are basically 2 ways a company becomes an Indian resident. First, if it's an Indian company to begin with, then it's a resident. Duh, right? But for a foreign company, it all comes down to something called its place of effective management, or POM. So what on earth is POM?
Well, it's not just about where the board meetings are held. The tax authorities look deeper. They want to know where the real decisions are made. Where do the key strategic choices that actually drive the business happen? It's all about substance, not just what's on paper. Basically, where is the company's brain?
And that brings us to the final fascinating layer of this whole puzzle. So once you figure out that you are a resident, there's one more question to ask. Are you ordinarily resident or not ordinarily resident? This little subcategory, NOR for short, can give you some amazing tax benefits, especially on foreign income.
So, who gets this special NOR status? Well, it's for a few specific groups. Maybe you're a new or returning resident, or one of those high-income visitors we talked about, or even a deemed resident. Getting this status is a huge deal because it can shield your foreign income from Indian tax, which is a major win.
So let's just boil it down. It's a two-step process. First, you figure out, am I a resident? If the answer is yes, then you move to step 2. Do I also qualify as not ordinarily resident? It's an absolutely crucial distinction to make. And that brings us to a final big picture thought. All these rules are based on physical presence, right? On counting the number of days you spend in a place. But in our world of digital nomads and remote work where you can be anywhere, it makes you wonder, are these rules, built for an older world, actually ready for the borderless economy of the future? Something to think about. Thanks for joining me today.